Hello, Accounting 1. This is going through 8-1 in our textbook, 8-1 in our textbook of recording closing entries. Now, after you've done the worksheet at the end of the fiscal year or at the end of the period, maybe it's the end of the month, there are temporary accounts that we have to close. And in your textbook on page 214, it actually lists those. You have to close your revenue, which is your sales. You have to close all your expenses, your owner's drawing account, and the income summary account. And we haven't used the income summary account yet, but this is when it comes into play. So we're at 8-1, work together. And the first part of this is to journalize the closing entries. So if you scroll down, you will find that you have the worksheet for this company, Fix It Now. You have the worksheet for them. And you also scroll down some more and you'll find that we have a general journal, page 8. And in the general journal, it's already started that they put in here the adjusting entries already for this worksheet. And now we're going to be doing closing entries. In closing entries, you'll see here that it has a heading that's centered in the general journal. This is still the end of April 30th. And we have to close out these temporary accounts because the management always wants to start with a zero balance going into the next fiscal year or the fiscal month or the fiscal quarter or whatever it is. So we have to, these temporary accounts, we have to close them back to zero and then start a new month, start them fresh. All right, so we're going to start on page 217. This is where we're going to start. This is the first one that we have to do, and it's closing out sales. All right, so closing out sales. And in this case, we have sales, and we had to figure out the dollar amount of sales for this worksheet, and it's right here, line 10 of the worksheet. It's $2,060. And so we're going to put that in, $2,060 in the debit. Now, if you remember, normal balance for sales when sales increase is a credit. To do this, where we're going to put this as a debit, this will actually zero out the account. Now, the other account that we're going to use in this case for this is another temporary account, and it is called Income Summary, and it's only used at the end of the period so that you can close out your accounts, close out these temporary accounts. It's just a very temporary account that we're going to use. So we're going to debit sales this time, and it will make sales go to a zero balance. And the income summary account is just an account to hold on to this dollar amount until we're ready to close it out. The income summary will close it out in just a minute as well. Now, the next thing we have to close out are the expenses, and this is the example is on page 219, for you. And we're going to use the same date, April 30th, and this time we're going to do income summary as the debit because we're closing out expenses, and expenses have a normal balance of debit, a normal debit balance. So to close them out to zero, you have to credit them. So we have to go up here and we have to see for this company, we see that advertising expense for $460. $460 for advertising expense. And then the next expense up here is cash short and over for $6. Cash short and over $6. And the next one is going to be insurance expense. Insurance expense for $125. Insurance expense for $125. Then we have miscellaneous expense for $189. $189 for miscellaneous expense. And then after miscellaneous expense, we have supplies expense for $153. And then next we have utilities expense for $550. Okay, so debits have to equal your credits, and we have all of our expenses here, but we don't have a dollar amount for our income summary to close out the expenses, and this is because we have to add up all of our expenses. All right, so I got 1483. I'm gonna add it one more time, just make sure I'm right. I didn't hit any wrong buttons. $1,483. Okay, so that makes it so that our debits equal our credits, and we close out the expenses. Again, expenses have a normal debit balance. To close them out to zero, we have to make a credit balance. Okay, we have to put it in credit to balance it out, to cancel it out. All right, so the next thing that we have to close out is the example is on page 220. All right, and here we're going to use income summary as our debit, and we go up here to our worksheet and we see net income of 677. Net income of 677, and that's what we are closing out, 677. And then we're going to use the capital account, because anything that the business makes goes into capital. Connor Whitney Capital. Connor Whitney Capital. Connor Whitney Capital, and 677. Okay, doing that right there, that closes out the income summary account. And we have one more to do. We have to close out the drawing account. Now, the drawing account has a normal balance on the debit side. Remember our DC Adler? Well, the D in add is drawing, and that comes under the D as in debit. So your normal balance for your for your drawing account is debit. To offset that, to bring it down to zero, you have to credit it. So Connor Whitney Capital and Connor Whitney drawing. And now we got to go find out how much did Connor take out of the business for the drawing account. And Connor took out $1,700. Come down here with 1,700 and 1,700. All right, so my debits equal my credits, and I have closed out sales. I closed out all of the expenses. I closed out income summary, and I closed out the drawing. All right, so we're going to grade step 1. Now scroll down, and it liked all of our answers. Okay, so we got 3 points out of 3 points. All right, again, we just followed the example that was in the book. That's all we did. Now we're going to go to the next step, which says post-closing entries. And with this, we have to take those things that we just put into our general journal for closing entries. We now have to post these to the general ledgers. So each one has a general ledger or like an index card to keep track of what it's doing. So we're going to start with sales. And this is General Journal, page 8. So we're going to, when we post these, we're going to say that we found this information in G8, General Journal, page 8. So I'm going to start with sales. We're going to credit sales. We're going to use the 30th. Remember that G8 I just told you about? General Journal, page 8. And we are debiting $21.60. And I have it here in debit because up here on my general journal, it's in the debit column. See? It's in the debit column for sales. What this does down here is this is a debit, and we already had a credit balance of the same dollar amount. But these debit and credit are like oil and water. They don't mix. They don't mix whatsoever. So you have to subtract these two. And when you subtract them, it equals out to 0. They cancel each other out. And this is what we mean by closing it out. You've now closed it out to 0. Okay, so we've closed out the sales account to 0. Next month we can start all over again. But with this posting, we have to take this account number, 410, and we have to post it up here. And this shows that we actually post it to the ledger. It's posted to the ledger. Now we've got the income summary. We have to come down here to income summary on the 30th, and we got to put, nothing's there yet, so we have to put April 30. And G8 again. And this time we credit $21.60. Okay, so nothing's there, so this is the new balance, $21.60 credit. Here's our account number, 330. I'm going to move that up here and put 330 in there. Okay. So now we come to income summary again. Income summary, and this time it's a debit for the 1483. 1483. 1483. We still got this on the 30th. Got it off of G8. And now, debit and credit, they are opposites, like oil and water. They don't mix, so we have to subtract them. But please notice that the higher dollar amount is credit. So when we subtract them, the remainder is still going to be in credit. The remainder is still going to be in credit when we subtract them. And the remainder is $677. And I know we just saw that just a minute ago. So here's income summary. We just finished that posting. Account number 330. Got to take it up here. 330. Advertising expense. All these expenses are going to be credited to make them back to zero. So we start with advertising expense at 460. Wow, they are the same dollar amount. Credit and debit, you subtract them, and they cancel each other out. That's been closed now until the next month. We have to take the account number 510 and put it up here to show that we did post that. Cash over in short for $6. Debit credit, we subtract them. It cancels out. So that account now is closed for the month of April at a zero balance. Nothing to draw on to the next month, to May. Account number 520. Insurance expense for 125. Insurance expense. $125, debit and credit, goes to a zero balance. 530 is our account number. 530. Miscellaneous expense is the next one at $189. It was credited. It already has a debit in there. When they're different like this, they cannot be added together. You have to subtract them. They cancel each other out. This expense has been closed for the month. $540 or 540 is the account. 540 is the account number. Next, we have supplies expense for 153. Debit and a credit. Cancel each other out. It's a zero balance. Account number 550. Last expense we have is utilities expense for 550. And that cancels that out, so makes it a zero balance. Now we have the account number 560. And then we're done with the expenses. Now we have to close the income summary account. So the income summary, we have to go there and debit it for $677. Income summary, we're going to debit it for $677. Now you see the debit, and it had a credit of $677. Debit, credit cannot add together. They're oil and water. So we have a zero balance. We have now closed out the income summary for the month. That was account number 330. Put the 330 in there. Show that we have posted that. Now we have capital. We have to go to capital and put the 677 in capital. And if you remember, capital, owner's equity, has a debit or credit balance. It has a credit normal balance. So what you're doing is this is the profit for the month, and you're just adding it to your capital. You're adding it to your capital. So we go to capital. $677. Now this is a credit and this is a credit. They are like oil and oil. You have to add them. All right, so I got 8120, but I'm going to add it a second time just to make sure I got my numbers right. 8120. Good. Okay. So now I have to take this account number 310 and plug it in up here. 310 for the capital. Now we have capital again, but this time it's in the debit column because now we're closing out the drawing. And remember, drawing is when the owner takes the money out of the business to use for their own personal use, for whatever reason they want to use it. Okay, so now we have to open up the drawing account. Oh, sorry. We have to do the capital first because capital is the debit. So we get 30th of the month. It's still G8 that we're using. And this is debit. So now we have a debit and a credit. We have to subtract them, okay? But notice that there's more money in the credit column, so the difference will stay in the credit column. And I got 6420. I'll do it one more time just to be sure. 6420. Okay, so now what happened is that they started with $7,443 in capital. They added the profit of the month of $677 to that to get $8,120. And then they had to subtract out the money that the owner took out for his own personal use. So now in capital, they still have a balance of $6,420. All right, capital is what's still due to be paid to the owner. It's what's still to be paid to the owner. All right, so they still have money in their account. That's account number 310. Now the capital account doesn't get closed out, just the drawing account, but not the capital account. You want to have money that keeps going. That's a good thing to have money that keeps going on in your capital account. So the last one we have to do here is on the 30th, and it's the drawing. And it says credit for $1,700, which credit and debit cannot add together. They have to subtract them, and it balances out to zero. And then we take our account number 320, and we post that to show that we have posted that balance. Okay. So now we have, we have posted all of these to all of these accounts. And now we're going to come down here, grade final step. And we can take a look at it. And it likes everything that we did. We got a point. And when you go through here, you'll see that all of your assets and your liabilities and your capital account still have balances. Those balances will keep going. However, your sales, your drawing account is at 0. Your income summary is at 0. Your sales, and then all of your expenses, all the way through here, all of your expenses are all 0 balances. And you have closed everything out. And we will save and continue. And then you can go on and you can do the work on your own by yourself to see how you do, and just give it some practice. All right. So there you have it. We'll see you next time. Bye.